take time to get back to you. Okay, when they take time, why they take so long to get back to you? Because they're checking your secret CTOS, and then they will compute the ratio, and then they will check on the ratio whether the ratio is matched to their requirement or not. So if let's say the ratio is meet the requirement, then your loan is okay. Also, let's go through one by one. Okay.
Okay.
So ratio analysis. So it's another tool that banker will use this as a financial ratio analysis. Ratio permit review company. Okay. Ratio will give the ratio can let you compare to the previous year. Okay, but this year ratio compared to last year ratio, whether why there's a big difference, then they'll ask question now. And then the ratio will compare to different industry. Okay, so bank they have a pool of customer. So let's say you are in the let's say a food industry. Okay, certain food industry. Let's say in the Western food industry. So they will compute your ratio. Then after that, they will compare your ratio to your industry player. It is your competitor or industry. Then they'll see whether your ratio is reasonable or not. So if let's say not reasonable, then they'll ask why. Or why people, let's say, do it certain ratio, then you do it another ratio. What is the reason? Also, ratio give bank have a chance to compare and also compare the previous year. So this year you have this set ratio, but last year different ratio. So why? So from our accounting point of view, try to consistent the ratio. Try if possible. Then you will create you won't create more trouble for you. Okay, even to auditor. Let's say I was an auditor before those days. So when we have different ratio, then we have to explain a lot of things. Then you find out more, take more info to justify it. If let's say a ratio is consistent, you just put one line on it. The ratio is no significant difference compared to last year. That's it. Skip the whole thing. So same thing happened to the banks. So if let's say your ratio is consistent to the previous year and also not so much different from the industry, then it's okay, settle. So for ratio, I mentioned just now before, we go to one by one. So profitability ratio, okay. Profit is the compensation a company receive for a risk that the business venture into. So many banks will look into two profitability ratio. One is gross profit ratio. It's called gross profit margin. Another one is called net profit margin ratio. Okay, these two. So the formula is GP, gross profit, divided over the sales revenue. Another one, net profit, is over the revenue. So net profit over revenue. Another one is called profit over revenue. Okay. So it's looking into the consistent of this ratio, just like I mentioned. If these two ratios appear to be dropping over time, so it could be a signal that the company will soon experience financial problem. Okay, so let's say your net profit ratio keep dropping. It means you're making less and less each year. Let's say your net profit is 10% last year, so this year become 5%. Then why suddenly drop 5% margin? What is the reason? Same thing happened to gross profit. Why your GP drop? Is it your cost higher, or your selling price lower? Or this could be a reason. That's why it's good that for a business owner, you know a little bit of this kind of ratio, then you know how to play around it and how you plan for it. Sometimes you have to plan for it, okay. Okay, so the second ratio is liquidity ratio. Okay, liquidity. Okay, the liquidity is cash. Okay, you see how much cash does your business have on hand for immediate use. You see, so again, just now I mentioned that cash flow statement is very important. Okay, cash flow statement is to make sure that you have enough cash to roll your company. Okay, so this is another ratio to make sure that the company gets enough cash. Okay, what is the ratio? Okay, formula. Okay, there's one called current ratio. Okay, current ratio is your current asset okay, divided your current equity. Okay, so current asset, what is inside current asset? Okay, current asset is bank, okay, your debtors, your customer owe you money, your stock. It means this is very current. Current means it's a very short period of time. You can get back your money. That's what it's called current. Okay, you can collect your debt from your customer. It's called debtors. Or you can sell your stock. Then you convert your stock into cash. So that's why it's called current asset. So FD also in the current asset, or bank balance also in your current asset. It means you can convert into cash. Okay, current liability mainly is trade creditors. So you owe people money. You owe people money, bank overdraft, bank loan, tax. Let's say owe tax authority. This is called liability. So the formula is current asset over current liability. Okay, banks normally prefer to see this ratio more than 1. Okay, it means current asset over current liability is more than 1. It means it's healthy. It means you can cover. Let's say I sell my stock, I collect all my money, I'm able to pay my creditor, I pay my bank loan. Because the ratio is more than 1, I can manage to do so. Okay, if it's the other way around, then the signal of having some danger is coming out. Let's say the last one. If current liability exceeded current asset, the current ratio is below 1, then the company might having problem within the short-term or short-term obligation. Okay, if they're having short-term obligation, what they do, let's say now, say for example, I sell my stock, I collect all my customer money, I still cannot able to pay off all my creditor money and or bank loan because the ratio is less than 1. Then how? So then after that they will sell the fixed asset. Maybe sell your house or sell your factory, to convert cash to pay them. So that's why in a healthy kind of ratio, we always think that it's more than 1. Okay, current ratio must be more than 1. Okay, so the third ratio